Welcome guys to the first anti-hedge conference. Today we're going to be covering all the main subjects of crypto, whatever you need to start. To all you guys who are watching on the Patreon, welcome. You're officially here. To everyone who's watching on the YouTube, you're going to be seeing it piece by piece, so bear with it. We got our financial advisor, the person they all were so excited for last time. She's going to be joining us. She's going to be co-hosting this event, more or less. And I guess we're just going to jump right into it. This is not financial advice. We don't accept liabilities for any losses that you might incur along the way. Everything here is strictly for news, research, and information purposes. So with that in mind, you should be able to enjoy the content of this seminar. What a big change. I even got suited up for you guys, so please enjoy it. You might not see it for a long time. So guys, what is blockchain? I'm going to start right now on that. What is blockchain? Blockchain is, more than anything, a database. It's a type of database. So everything that has been set up to this point in terms of data for everything has strictly been like a center that just receives data. And it's not organized, it's just a mess, a back-end mess that people could basically use if they have people organizing it as they go. But it's very complicated to do that. Now, all blockchain really is I'll even draw it for you. It's literally just a chain of information. That's a pretty ugly block, but whatever, it's okay, because the concept is the same. It's just a chain of information, constantly chained to each other. So the first transaction or the first piece of block information is connected to every other part of the chain at all times simultaneously, meaning that people who are working with data could get to anything they want relatively easily in an organized format. And why is that important? That's important because up until this point, data has just been raw. This is something that's taking data and it's able to put it in a format that allows people to basically use it in an actual setting. So up until this point, people were just like, okay, we have all this data, now we have to sift through it to get information or anything valuable out of it. Which, you know, that's costly. You need people to do that, and it's not really effective because you're probably going to lose a lot of data along the way. Consider it like as if you're straining pasta. All those holes are what you're about to miss while the water is basically going in. So you're losing that data, and that's what this is. It's a system of organizing data that has basically been a concept for the last 12 years, more or less. Now, beyond just what's important about for that data is this. It's public, meaning that everyone has access to this data. And not only does everyone have access to this data, it's immutable, meaning that once it's been laid out on the blockchain, it could not be changed. No one could just come and fiddle with it. It's set, it's immutable. In order to actually mess with the blockchain's information, it would cost millions of dollars per second and quantum computing, and even then it might not even be possible. So it's an extremely costly process to actually mess with the information. And if you do mess with the information, guess what happens? Basically, the blockchain will revert to the previous state before that mess up happens, and then it just basically starts from there. So you will have corrupted one piece of information only for it to restart at a previous state. That's pretty crazy. But I'm going to tell you one more thing that's important about blockchain. And I wanted to stress this at the beginning of this seminar because of how important it could be long term. Right now, we're constantly seeing corruption and governments just messing around with people, banks fiddling with numbers like it's not an honest system. We know that. Everyone knows it. And everyone's main argument is, well, we don't have anything better. Well, ding, 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 ding. It's about to get better. You know what I mean? Like, it's about to get much better. So imagine now you have a system that's public where everyone could see it and everyone has to adhere to this system and respect it, right? It's upheld by computers. Computers are upheld by code, and code just does. If you tell the code, make this happen in terms of, I want my information laid out so everyone can see it, guess what? You're not gonna mess with the code. And if you do, like, good luck. It's not exactly that easy. It's set and it's encrypted. Now you take a government and you tell them, hey, we want everyone to be using a blockchain standard. We want our governments to be public. Let's say now you take a politician. I'm not even gonna state a name, just so I'm not biased. You take a politician and he decides, okay, we're giving money in taxes to go send to this to build a road, to this public construction company to build a road. Now, you're thinking, okay, well, there's bound to be slippage. There's bound to be something where money will disappear, right? Well, not anymore, not with this system. Because now, let's say you have $1 million that's supposed to go to this public work. The second that money is not sent to that address, which will be delegating the work for the public, you know it went to the wrong address. Where is the money? Where's the money? That's corruption. You're out. There's no hiding it. There's no like, oh, well, it was just a little thing. It's like, no, you did not send it to the correct address. You sent it to another address, and that address was in the Bahamas. You're fired. Get the fuck out. We don't want you. That's it. That's why governments and banks hate it, because they understand that it's the end of dishonesty within a system. It's a system of trust. There's a reason it's upheld by the numbers and not by the people, because people lie, numbers don't. Numbers just add up. That's what they do. That's what they do mathematically. That's what they do in every other sense of the way. So I put my faith in the numbers before I put my faith in the people. Fair.
Good job, Matt.
Thank you.
That was a really good explanation.
Thank you. Thank you. I appreciate that. So it's like, I will also state this. There's going to be a Q&A at the end of this video. Y'all are going to catch it. We have a few people here that are going to be asking questions. Obviously, this is a smaller scale seminar, and they're only going to get bigger as we go. The next thing that I wanted to talk about, what is crypto? The elusive magic internet beans. Now I'm going to tell you all about them and how they work and why they work and why it's a system that actually works perfectly with blockchain. What is crypto? I'll start off in a simple term. It's encrypted money, meaning that currently you are taking money, value, you are encrypting it in a vessel. That basically means that it cannot be hacked. It is encrypted money. So now to fraud it or to do anything against it, it's not really that simple. And especially too, because specifically with Bitcoin, I'll use Bitcoin for an example, they have a SHA-256 encryption with an elliptic curve, meaning that, yeah, that sounds ridiculous, but I'm about to break it down extremely simply. All this means is that as the network grows, the cost of messing with it goes parabolically upwards, meaning that today, every second to hack the Bitcoin network could cost millions of dollars per second. Tomorrow, it could cost billions of dollars per second. You get what I'm saying? So as the network grows and more nodes and computers and usage happens, it just means that it's more expensive to actually mess with the encryption. And that right there, it's a type of encryption that as it grows, it just becomes more and more secure because of that. So it's really the most sound form of money. And now I'm about to throw in the next most important thing about crypto, because people are just looking at it in terms of like, okay, cryptocurrency, it's a fancy name, what does it do? Well, I was talking about all that data before, right? So we have data that is raw, and we have companies that capitalize on this data, and guess what? They never paid us for it. They took all of our information, they never even gave us a penny off of it, but they sold it to everyone around them. Well, cryptocurrency is literally the monetization of our data in a way that gives us control over it. Meaning that I know that no matter what, whenever I'm surfing, my data is being given. It's done. There's nothing we could do about that because we don't control the internet and we don't control the companies that handle the internet. But with these kinds of systems, blockchain systems, and with the new Web3, that new structure that's coming to the internet now, we'll be in control of our data and who's actually going to be receiving it. And in return for that, we get paid. So what it really is it's money backed by our data. And the reality is that our data will be used. That's inevitable. There's not much we could do about it unless you decide you want to turn off the internet and live off the grid. So that's why I would rather get paid for it. And I'm sure many people would like to be paid for their data as opposed to just having it taken from them and, complain about it. You might as well get a few bucks while you're on the process of doing that. Whew, all right. So that was definitely a good way of breaking down cryptocurrency.
Very good.
Now, the next thing that I wanted to talk about is some of the potential things that you're going to be seeing in a crypto environment. And I'm going to start with, what is a smart contract? Ooh, that's a nice word. Everyone's heard it. It's a hype word. It's a buzzword. Everyone wants to know what the fuck it is. Well, I'm about to break it down in a way that you could understand it. This is what I love doing. So, what is a smart contract? It is a self-executing contract. Sounds pretty simple, and it is, because I'm about to explain why it's so simple and so valuable and what its use cases could be. Let's say now I wanted to get a mortgage. Standard thing, everyone wants to have a house. Everyone wants a home. They want to have their family and their home. They want to have the American dream. But guess what? That's expensive nowadays. You got to call your bank. You got to call your notary. You got to call your mortgage broker. You got to call basically all these people along the way, and if not more, because you might even need a lawyer to litigate this whole thing depending on what exactly the scenario is, or it's just a lot of people. And all these people along the way are going to be basically taking a percent here, take a percent there. They're all sticking their finger in your pie before you even get it. And who wants a pie that's been, violated? I'm sure you guys have seen American Pie. No one wants to eat that fucking pie by the end of it. Nobody does. And no one should have to. Yet, we allow ourselves to eat that pie. Not with smart contracts. Here's the beauty of a smart contract. So, like I said, a self-executing contract. You are basically going to take your mortgage with a DeFi institution, for example, decentralized finance, and we'll get into that a little bit later on into this seminar. So you're going to basically take a loan against a DeFi smart contract, which will be like a lending protocol, which is basically you take on a mortgage, and instead of you having to call all these people, you don't anymore. Now you're like, okay, I'm going to take a fixed rate at this, and you're going to settle all the things you normally would in a contract more or less yourself or with one person, maybe a lawyer or a notary, one of these people. And then you're going to figure out based on your contract what you're eligible for. And then from there, you're just going to pay that contract. And because you are taking in less people around to eat off your pie, so to speak, you're going to end up in a scenario where instead of paying, let's say, 3 or 4% for a mortgage, you could actually get it down almost to 1% consistently or less. And as the system grows, think of it this way. There will be a lot of costs reduced. So because costs are reduced, that means that even if, let's say, a financial institution takes on a lower interest rate, it's more valuable for them because they've knocked out hundreds of thousands, if not millions and billions of dollars of costs over time and potential mess ups in the litigation or this or that, because those are all costly. One mistake, you have to call all those same people and they all got to put their finger in your pie again. But a smart contract is already designed and it's upheld by code. So then from there, you will just be paying a mortgage to the contract. And then by the end of the contract, you'll basically have the deed to your house released in an escrow, and then you own it. That is your property. You are the owner afterwards. So you are officially knocking out all these people, all these middlemen who have been making millions and billions, as Trump would say, millions and millions and billions. They're making so much on your head. You have an opportunity now where you could even potentially use a smart contract directly with the person who's selling the house. So you're reducing your costs to a point that they're almost at nothing. And that's why this is so important. And mortgage is just one application. Imagine for other things, government contracts, a regular contract, even just like let's say you're just helping someone for work and you're building a house, that's a contract, right? A contractor, he could use a smart contract to make sure that his person pays. And guess what? If he doesn't pay, it's upheld by code afterwards. You know what I mean? Like you could take that way easier to court afterwards because it's already set up in an escrow. Like shit has to get done, and it's protection from both ways. Meaning that if the person doesn't pay you out, well, they can't because in order to actually start the contract, they actually have to put the money in to some degree. So it's like no matter what, as a consumer, you're always in, and as a person who's working, guess what? You're only getting paid once you respect the consumer. So it actually even brings back trust in small scale applications that, like let's say you pay someone to do a job and he doesn't do it. You don't have to go to small claims court anymore because now his escrow only releases after he actually does the job properly. or depending on the terms written in the contract at that time. So that's smart contracts for you.
Very nice.
Thank you. Okay, so look, the next one, Mick's gonna say her piece on it. It's what is a wallet and an exchange.
Mm-hmm. Okay.
Go for it.
Should I grab your mic?
Yeah, definitely.
Hang on, I'm just gonna write this.
Yeah, definitely write it because my handwriting is trash, and I would not. Well, actually, maybe I could be a doctor with it. But don't trust me to do surgery because this isn't financial advice and it ain't gonna be medical advice. Here, take it.
Thank you.
No problem.
I just clip it like.
Yeah, and yeah, just clip it on.
Like that?
Yeah.
Is that good?
Yeah, I think you're okay from there.
Okay.
And from there, could you also give a shout out to Alien Number 1 because he has been begging for that shout out.
Alien number 1, thank you so much for your support. I'm glad to be back on the channel with Matt here. And now we're going to talk about what is an exchange and a wallet. Okay, so with regular money, you have a wallet. You keep your paper bills in your wallet, and that's just where you store your money. In crypto, you have to have a place where you keep your crypto assets, and so we call that a wallet. So there are different types of wallets when it comes to cryptocurrency. By far, the safest type of wallet to keep your crypto in is called a hard wallet. And the most popular hard wallet is called a ledger. So this looks like a USB key, and you basically plug it into your computer and you transfer your funds onto this. This wallet is virtually unhackable because it's not connected to the internet. And so the only way that someone can actually hack this wallet and take your funds is if they physically steal the wallet from you, or if you give them your secret password. So you cannot hack this wallet unless someone physically robs you, or unless you tell them your password. So this is super safe. This is the best way to store crypto that you're going to be holding for the long term. So in cryptocurrency, since there are so many different types of cryptocurrencies that we'll get into shortly, a lot of people like to do some trading. And so when you do some trading, you have to go online with your crypto. And so when you're online with a crypto, we use what's called a hot wallet, which is basically an online wallet that you keep your crypto in. So the most common one is MetaMask. And this is basically just a Chrome extension that you have to download. And when you buy crypto, you will transfer the funds to your MetaMask or hot wallet, and then this is considered your wallet on the internet. So you have to be extremely careful with this because you don't want to accidentally give your seed phrase to someone. There's a lot of scammers out there, but we'll talk about that at the end of the seminar. So this is a hot wallet, and this is what you will use to make most of your crypto transactions for the crypto that you don't want to store away and hold on for the long term. So now let's talk about exchanges. Okay, so exchanges are where you will buy crypto assets. So in the traditional financial world, we have exchanges for stocks, right? The stock exchanges. So you can view the crypto exchanges as a similar parallel. So crypto exchanges is basically where you will buy your crypto. Some exchanges allow you to directly transfer your fiat currency, your Canadian dollars, your US dollars, onto that exchange and then directly buy your crypto from there. So on the exchanges, a lot of them, you can buy and sell your crypto assets. You can trade with them using leverage. What else can you do? You can look at the charts. There's a bunch of things that you can do on these exchanges. However, it's important to keep in mind that these exchanges, they are centralized, which means that someone has the power behind these exchanges. So the exchanges themselves can be hacked, okay? Because it's a network and it can be hacked. And so if you decide to buy cryptocurrency on these exchanges, it's important that you transfer it out of the exchange onto your wallets just to be sure that your funds are safe. In crypto, we say not your keys, not your wallet. And so not your keys, not your crypto. And so if you leave your crypto on the exchange, it's technically not your crypto because the exchange could go down, it could get hacked, and you don't want that to happen. And so that's very important. So that's it for exchanges and wallets. This is where you buy your crypto and where you store it. So now we're going to talk about the difference between Bitcoin, Ethereum, and Dogecoin. So these are the three biggest cryptocurrencies, well, the most popular ones at least. And we're going to break down the differences between these three cryptocurrencies because they don't all do the same thing. Contradicting common conception, Bitcoin is very different to Ethereum and to all of the other currencies. They have different use cases, okay? So we're going to start by talking about Bitcoin. Bitcoin is the papa crypto, okay? It's been around the longest. It has the biggest in market cap. In fact, it makes up half of the total market cap for all cryptocurrencies at just over $1 trillion, which is crazy, okay? It's considered one of the biggest companies, even though it's not a company. It has more capital in it than Apple and Tesla and all of the big companies that you can imagine, okay? So why? What is Bitcoin? Why is it such a big hype and why do people love it so much? Well, I'm going to break that down. Okay, so Matt did a great job of explaining blockchain before, and Bitcoin is basically operating on a blockchain, okay? The best and most simple way to view Bitcoin is to view it as digital gold, okay? So what is gold? Well, gold is a precious metal. And why do people buy gold? People buy gold because they view it as a hedge against inflation, okay? So I'm gonna break down what inflation is because it's a very important concept to understand in order to understand Bitcoin. So inflation is basically what happens when the cost of life goes up. So if you've noticed recently, the gas prices has gone up, the housing market has gone up, the stock market has gone up. This is inflation because you're still getting paid that same 30K, 50K that you got paid last year, but now everything else around you is costing more money. And so you can't afford the same things this year that you could afford last year. So your money is losing purchasing power. The reason why people buy gold is to protect your money against inflation. And therefore, if inflation goes up at a rate of 3%, gold is expected to also rise in price relating to that price at 3%. And so if you're keeping your money in your savings, in your bank account, and you're not investing it, you're actually losing value to inflation. And so that's why people buy gold. They put it in gold so that the price of your savings will rise with inflation, and at least you will be protected. So Bitcoin is known as digital gold because it has similar properties. Okay, the properties that Bitcoin holds is that it is very scarce, and that is the number one reason why Bitcoin is valuable. So Bitcoin is basically an equation on the blockchain that makes it so that there can never ever be more than 21 million Bitcoins. There can never exist more than 21 million Bitcoins. And so what does that mean? Well, if you look at the fiat currency, the standard that's established here in Canada or in the United States, we have fiat and there's an unlimited supply of fiat. This means that the government, the Fed, can create money out of nowhere. And this is what causes inflation. So with Bitcoin, there's a set amount of Bitcoin that can ever exist. So what happens is as the government and the Fed prints more money, more and more of that money will flow into Bitcoin. And since there's a capped supply, the price of Bitcoin can only ever go up. And also, it is widely accepted now as digital gold. It has a huge network of over $1 trillion. This is really crazy because the fact that it's so widely adopted and it's so scarce and it's so immutable because it's on the blockchain, it's so transparent, everyone can see it. It has the trust of the people. It operates on a peer-to-peer network, which means that everyone who holds Bitcoin is part of the network and can see into the network. So this is currency for the people because it's so transparent. You have your government who can create as much money as they want out of thin air, yet they tell you that you still need to pay 40% in taxes. Why does that make sense? So Bitcoin is here to take away that inflation, but also create an asset that is transparent and that operates for the public. Okay, so that's Bitcoin generally, and we'll be taking questions at the end. I hope that was a clear explanation. The next crypto we're going to talk about is Ethereum. So you've all probably heard of Ethereum, and a lot of people say that Ethereum is better than Bitcoin, and that's not the case because they're two very different things. They're not the same crypto at all, and they have different use cases. So Ethereum is used for something completely different. So Bitcoin itself, its use case is digital gold. It's used as a hedge. Ethereum, however, is its own blockchain, okay? It has its own blockchain separate than Bitcoin. And what Ethereum does is it allows for smart contracts to operate on it. Like Matt was talking about smart contracts. And so with Ethereum, you have the basic underlying blockchain. However, you can build other decentralized applications on top of the blockchain, okay? So this allows the crypto network to grow in crazy ways. So you guys, we're going to talk about NFTs and DeFi. These are different cryptocurrency concepts, but it's important to understand that Ethereum is the underlying layer that allows other websites to be built on top of it. So the best parallel for Ethereum is to look at it as the internet. So you have the internet, and then on the internet, there's different websites. You can build different websites on the internet. And so that's the use case to Ethereum. It allows for the basis of other crypto projects to develop on top of it. With Ethereum, whatever's operating on that network, we use the cryptocurrency called Ether, also known as ETH, to do any transactions that we want to do on these decentralized applications. So whenever we are interacting with the Ethereum network, we're never directly interacting with the network. We're interacting with the applications built on top of it. And so it's two completely different things. So those are the two most popular cryptocurrencies that exist today. And as you can see, there's different use cases. And today I'm going to talk to you about Dogecoin and Shiba Inu because they've been all the hype this bull run and the past bull run. So what is Dogecoin and what is Shiba Inu? Okay guys, are you ready for this? They are jokes. Like that's literally what they are. They have been created to be jokes. And initially when Dogecoin was created, it was created as a joke to cryptocurrency because back in the day, no one really believed that crypto was going to be a thing. And so Doge was created to make fun of cryptocurrency. It was created to say, hey, like, yes, Bitcoin is great, but I can also create another Bitcoin that's a little different. They're different because Doge is not, it doesn't have the network and it wasn't adopted first. However, it has more supply than Bitcoin. And so because of its exponential supply, it doesn't have the same use case. So with Doge, it was literally just created as a joke. And it's the reason why the price went up was because Elon Musk just loves to joke around. And so he decided to use his power on Twitter and just shill the coin. And that's why the price of Doge went up. However, it does not have a use case. It's pretty much useless unless Elon decides to start allowing you to pay for it when using Tesla, which he has. So, you know, that's kind of a special situation because it was adopted by Elon. However, there are some other coins such as Shiba Inu and all of these other meme coins that have completely no use case and that are being hyped on social media for rug pulls, basically. So influencers will basically hype these coins up. They will tell you to put your money in it and you don't know why you're doing it, but everyone else is doing it, so you're going to do it. And what happens is that the price rockets, it goes up, and you think you're making a lot of money, but all of the people who hold all of the biggest wallets will take their money out, and then everyone else will be left with a loss. And so you have to be very careful with cryptocurrency and with meme coins. When you're investing in crypto, it's important that you do your research on the use case of the cryptocurrency. The rule of thumb is the bigger the utility of the coin and the bigger the network or the potential, well, the more likely the coin is a good pick. And so that's it for Bitcoin, Ethereum, and Dogecoin.
A few extra things to some of the things that she said, just to like give a little cherry on top, so to speak. So another thing too that I wanted to mention with exchanges is there are brokers and exchanges as well. And the thing that I wanted to add to that was this. A broker would be something more like crypto.com, for example, which will sell you multiple cryptocurrencies. It's linked to a bank and it's more, it functions more like a bank, right? And I wanted to add this into the explanation of an exchange because when you have an exchange or a broker like crypto.com, you could actually have access to other functionalities like crypto collateralized loans. So you could take loans against your crypto. You could stake within their network, and you could do more functions that are more like bank functions on a brokerage versus an exchange, which will just be to execute trades and make profit, similar to how you would do something like on a TD Ameritrade or a Wealthsimple or Robinhood or anything that is used to just handle stocks, right? So I just wanted to add in that little extra tidbit about the broker, because that will become a thing that is more common as we see more adoption for crypto. Already now in the States, they're allowing mortgages for Bitcoin, backed by Bitcoin, meaning that the fact that they're giving you bricks for Bitcoin, it means that there's some value there. So I mentioned this extra bit with the brokers and banks and how they're making functionality, right? She also mentioned too Bitcoin, Ethereum, and Doge, right? And I wanted to add in one more thing to that as well, right? Well, actually, you know what? That tidbit I'll add when I explain staking. I'll go back to that in the future part of this conference. So Bitcoin, fiat, gold. What are the differences? Obviously, she explained Bitcoin, she explained fiat, she mentioned gold. Now I'm going to break it down in a way where it's like you could understand the properties of each very well, so you could understand why Bitcoin is superior. Now, we have scarcity. Bitcoin is absolute scarcity, meaning that there will only ever be 21 million Bitcoin or less, because people lose them, right? Now, you have that scarcity, which is similar to gold, and it's quite valuable. And you got to ask yourself one more thing. So you have this value that's locked into the network, and now you got to ask yourself, okay, well, let's say we wanted to back an economy, because we've had gold back in the economy, then we've had oil back in the economy, and now we're heading into a new era. And this era is the digital era. And I'm going to break that down even more further, but I just want to get this point hammered in. Bitcoin is scarce, it is borderless, and it is immutable, meaning that it has all the aspects of gold and scarcity. It is borderless, meaning that it does not have to adhere to any individual law, meaning that if I want to send money from Canada to Russia, then off to South America, there's no one that could really stop that. It is borderless. No one could stop that. It is global currency. It could be used anywhere. And that's something that's extremely valuable, because the fact that it is borderless compared to fiat and gold, it means that there's less restrictions on what it could actually do. And the last important thing is being immutable. And the fact that it's immutable, it just means that it cannot be tampered with. A Bitcoin is, and as a Bitcoin does, it just is. It's what it is. It will move value in the most efficient way, and it can't be tampered with. And that's extremely important as we're heading into an era where we do see more censorship. We do see more tampering on what we see on the internet. We are watching weird things happen, especially during this whole COVID crisis. So let's be real. We won't get too political about it, but this is a system that cannot necessarily be controlled by one entity. It's a globalized entity. Now, the next thing I wanted to mention too was BTC versus fiat. So now fiat, you have pretty much the opposite. It's a centralized entity where everything is controlled, like she said, by banks and governments, right? Who are backing it with trust. What exactly is there to trust in a government that lies and a bank that doesn't honor its debt? What good is a bond if they're not going to pay their debt? Because that's really what a bond is. You're trying to receive interest off of the government investing into itself, and then you're banking on the fact that you could trust these guys enough to give you back your money. But the thing is when they give you back your money, will it come back to you at the same value, or will you have lost it due to inflation? Because think about it, when they start doing quantitative easing and they add to the money supply, bonds drop, they go to zero, you yield nothing. You are getting 0.25%, you're getting dick. What's the point of leaving your money there? You're basically giving the money to the government so that they could make you lose purchasing power. You are literally, it's like you're saying, hey, daddy, bend me over and spank me. It's literally what you're saying. And do you really want that? No, you don't. It's your money. It's the money that you're going to be using to buy food for your kids You know, you can't have it constantly being devalued by entities you can't trust. And that's the problem with fiat, is it's centralized and it's infinite, meaning that hold on, let me word this properly. The ceiling for Bitcoin is as infinite as the floor is for fiat, meaning that the more they print, because Bitcoin is an asset, it means it could just go up against the printing. Whereas the money itself being printed just goes down. And we watched officially, globally, we saw the US dollar and Bitcoin crossing on their purchasing power charts over the course of COVID. The beginning of that cross. And that is what we call a death cross, but for the US dollar. Meaning that as the US dollar continues its rounds of printing and destroying itself, imploding, Bitcoin just goes up against it. So you are literally hedging your bet against failing monetary policy. And if you've watched the last 10 years, the 2008 crisis and whatever crises you've seen over the last 100 years, it's a good place to be hedging your bet. Because failed monetary policy is like death and taxes. It's unavoidable unless we switch. Now, the last thing I wanted to mention too is gold. Gold, it's scarce, but it's centralized and immovable. Those are things that are an issue for one specific reason. So gold is scarce. It's not exactly easy to mine it. And the thing is to mine it is extremely energy inefficient. It's actually horrible for the environment. You are pumping clean water, which we could be drinking when there's a shortage of water, to pump it into the ground for shiny yellow rock. You're going to be eating your rocks when there's no more water to pump into the ground. It does not make sense to mine gold anymore. Back then it made sense because guess what? There was no other metal that could replicate it. It made sense hundreds of years ago. We are not hundreds of years ago. It makes no sense to say, hey, I'm going to be doing shit with gold. Unless you're taking it to hedge it against the dollar, it's pretty much useless unless you use it for technology and electrical conductors. But does that mean that it's worth a lot of money? It means that if anything, it's going to be more of an industrial use as time goes by. Because guess what? Now let's say now you decide to back an economy with gold. You're like, all right, we're going to go back to gold, everybody. So America now needs to make a purchase order with China. We're going to send 1,000 gold bricks. All right, get the boat to do it. Now you're paying the boat with the oil, which is destroying the environment after you just pumped the water to get the gold out. So you've just done two horrible environmental things. Now you get the extra added layer of like, how much is it going to cost to move it? It's not going to be cheap. You need to have security there because there's pirates now. So what if they come and see your gold and take it? There you go. Now you got to pay your security. Now you got to add in the whole other factor of like, can you trust this gold? Because years ago, China got caught sending out billions of dollars worth of gold. It was actually tungsten plated in gold, and it was going under the radar for years. Then they got caught. You know why? Because one day someone made a purchase order for gold, and then they went to check the validity. And when they run it through the machine, it flattens the gold. And if the gold isn't soft, like if it's filled with tungsten, for example, it's not going to go through the machine. It's going to basically just dink. It's not real gold. So now you've taken something, so it was scarce, but now it's not trustworthy as much anymore because now people are finding more and more ways to fraud it, and the more ways people fraud it, now the system is compromised. You cannot trust gold anymore. It's, in terms of like large scale production. And now even if let's say you pass those hurdles, you send the gold to China now. It takes God knows how long to get there because it's on a boat. Well, guess what? China has to go make a purchase order for something else. So now what? By the time the boat arrives with the gold after maybe a month or weeks, you got to send it right back to America. So what? The boat's just going to be going back and forth forever, moving gold? That's efficient, right? That's good for the environment. Better than Bitcoin, right? So that's when I laugh when people say we got to go back to that gold, moving gold around. And then to back it by a gold standard, good luck. Because the second shit gets too tight monetarily, people will just be like, hey, we're just going to go away from the gold standard. Now, that's another huge issue is the fraud and the fact that you can't really move gold around, and then the fact that it's so centralized now. The people who own gold, it's done. Everyone owns the gold now. There's not going to be a lot more gold for people to really get their hands on it. Roosevelt and Nixon made sure that all the gold ended up back inside the vault of America. Venezuela was a rich country. Then guess what happened? Gold got locked up in a bank in England, and now that Venezuela is poor and they're asking for their gold back, England says it costs too much to move it back. We're sorry, guys. Enjoy not having water. Kind of fucked up, huh? So they took their oil and they mined Bitcoin and they get water now. So that is definitely one of the main reasons as to why we can't go back to a fiat or a gold system. We're at a point where it doesn't make sense anymore. They're too centralized. Bitcoin right now has the opportunity where people could actually get their hands in and make it work. We have a new system in our hands. We can't allow the old system to take the new system and put it in the pocket again, because otherwise we're gonna have the same issues. Now, I'm gonna take a small break, 2 minutes, and we'll be back. So I wanna take a break for a minute.
All right, next thing we're going to talk about is NFTs. So NFTs have been super hot in the crypto space right now, and I'm going to break down what they are. So what does NFT stand for? An NFT is a non-fungible token. And that might sound weird, but I'm going to break that down even further. So what is a fungible token? Well, something that is fungible is something that is interchangeable. And so if you have a Canadian dollar and I have a Canadian dollar, we can trade those dollars and we will both still have $1. That's because even though it's a different dollar, it still holds the same value. So a non-fungible token would be something that does not hold the same value and is very unique in its value. So a perfect example of that would be my college diploma. And so I have a college diploma, it has my name on it, and it works for me. However, if you buy my college diploma off of me, it's not going to do much for you. It's only valuable to myself. So in the space of crypto right now, art, digital art, is the biggest form of NFTs. So if Matt makes a masterpiece and I make another masterpiece, they're going to be two different things and they're not going to be sold for the same amount because we have different techniques. Maybe he's more experienced as an artist than I am, and so his will be sold for more. And so that is a non-fungible token. So in the NFT space, what's really important and how this integrates with crypto is that NFTs have proof of ownership. And so this means that if on the blockchain I decide to buy Matt's piece of art, it is on the blockchain. It is now in one of those blocks, and that transaction can then be found on the blockchain. So I can have his artwork in my wallet, and I'm the sole owner of that artwork. No one else can own it. Yes, you could probably screenshot his work and use it as a background and pretend that it's yours. But if anyone verifies, they'll see that you're bullshitting because that artwork is linked to my address and not your address. And so NFTs is proof of ownership that you actually own something. So NFTs have been super hot in the space. I think the community is very, very big, and I think that's why the space of NFTs is really booming. So in the past, we've seen artists really struggle to get their work out there and to get their work valued because it is physical items, okay? And so if you are an artist, you can have your work maybe posted online, but your actual work will be in your gallery. And the only way that people can actually see your work is by visiting your gallery. And so the exposure that you get is very small because it's limited to the amount of people that are willing to physically walk into your gallery and take a look at your artwork. So with digital art, you can broadcast that on the internet. And with the Twitter community, there have been so many artists relating to each other, sharing their work, that on Twitter is just exploding right now. Artists are supporting each other, you have collectors buying their work, and you would be amazed by the talent that's out there. So right now, people are really connecting on Twitter with regards to NFTs, and mostly over the digital art. So another type of NFT could be anything. It could be anything that's non-fungible. So Matt was saying earlier, if you wanted to sell your house, you could do so through smart contracts. In that situation, your house would become an NFT, and the contract that would sell your house would transfer that NFT from your wallet to someone else's wallet using that smart contract, releasing the escrow once the conditions are met automatically. And so now you have proof of ownership of this new house that you bought. It's now in your blockchain wallet, on your wallet. And so this is what NFTs are. And they are revolutionary because now you have the proof, right? So this is going to, I think you're going to talk about Luxo here when you're talking about like handbags, designer handbags and stuff. So imagine buying a handbag from it's a secondhand handbag, you buy it online, and it's being marketed as the true value, like the true brand. Let's say you want to buy like a Prada bag. Well, you go and buy that bag for, I don't know, $10,000. I don't know how much a Prada bag is. But then it turns out that it's not even a real Prada bag. How can you verify that that is the true Prada bag? Well, now companies are coming out with ways to create NFTs linked to that product. And so you have the proof of ownership that you actually own this product. And so when you resell that item, well, you resell it, you sell the NFT instead of the physical item, and now you have proof of ownership of that physical item as well. So NFTs have their own use cases, and you can see how NFTs will really help bring the crypto world and the digital world together with the physical world. And so that's basically what an NFT is. Very cool things. So next thing I'm going to talk about is decentralized finance, also known as DeFi. So traditionally, we have banks, we have financial advisors, we have a whole financial system that's very complicated and no one can understand it unless you do 4 years of school, and even then you don't really know what's happening behind closed doors, right? Because the Fed has a final say and the Fed is a private bank and no one can see what they're actually doing. So with decentralized finance, it comes down to the idea that we are a bank, however, we are the bank, okay? So the way that this works is, in traditional finance, in traditional banking, you have what is called fractional reserve lending, okay? This is a big this is mostly how money gets added to the economy. And so let's say I am a bank and Matt deposits some money in my bank. Let's say he puts in $100. Well, the rules state that I can lend out 90% of that loan because statistically, no one's going to take out 90% of what they just put in the bank, so I can lend out 90% of his $100. And so my other friend here comes and is like, oh, hello, I would like a loan. And I say, okay, here's a $90 loan. And so Matt still has his $100. That $100 is still a part of the economy, but now I have created another $90 out of nowhere by lending it to him. And now this person can go and take that money and deposit in another bank, and then that bank can do the same thing. So this is a system that's kind of broken because it causes inflation, but also you have that system where the bank takes that money and invests it and capitalizes it on whatever money you're putting into the system. The bank is a central entity that is making profit from the money that you are depositing into it. And so this is a system that's only beneficial to the banks. It's detrimental to you and to anyone who is not a bank. In decentralized finance, the idea is that it's a peer-to-peer lending and borrowing process, okay? So this means that we have a bank, it's a digital bank. However, Matt can put in money in the bank, and I could put money in this bank. However, we know that people are going to ask for loans. So what this decentralized platform does is it will use smart contracts in order to pay out interest to me and to Matt. So now there's no one single entity making profit off of us. we are the ones that are making profits off of ourselves. And the bigger the network grows, the more profitable it is for us as well. So it's really a peer-to-peer network that operates on smart contracts that allows us to capitalize on the money that is otherwise capitalized by traditional banks. And so I hope this makes sense. So this is DeFi in a nutshell. There's lending and borrowing, okay? So you can come and borrow some money from this protocol. You need to have collateral in order to put up against the loan, but the interest rates will be determined by the amount of liquidity that is available within the protocol. And so that's the basics of decentralized finance. You can obviously go a lot deeper into this. And there are some protocols that are they're very exclusive to staking. And so there are some staking protocols that will give insane returns, okay? We're talking over 100% APY, which is unheard of in the traditional banking system. This means that you take a coin, you take some money, you lock it up, and you can get 100% returns per year just by locking up your money, by providing liquidity to the protocol. So this becomes very interesting in the sense that you can now make money, you can capitalize off of this because we're so early and so little people know that the interest rates are extremely high. And so I'm going to let Matt talk about staking with Ethereum. I think that's what you wanted to talk about.
Well, if you want, you could go over the base of staking, and then I was going to take over from that point. So I don't know.
Okay.
Yeah, go ahead. And piece on staking, and I'll jump in after.
Okay, well, with staking, basically what you're doing is you're taking your assets and you are providing them to a pool, okay? So you are taking your assets and you're basically providing them to a pool and that pool is going to lend out those assets as well. And so when you put your money inside that pool, your assets inside that pool, they either get locked up for a certain period or sometimes they don't. But if you decide to stake it, that's when you earn interest on your assets that you have put in the pool that will then be used to lend out to other people and will be used to do other things within the protocol. And so I don't know if you want to elaborate on the basics of staking.
Well, yeah, so I guess from there I'll take over from here.
Okay.
Okay, excellent. All right, beautiful. So we had a beautiful explanation about NFTs, DeFi compared to CeFi, as well as now we're going over staking. Now, she gave you a very good explanation of staking, and I'm going to go into it a little bit further while also addressing something else. So there are also basically consensus mechanisms within blockchain, right? So there's POW and POS, right? Proof of work, proof of staking. And before I delve and give a little bit more about staking, I'd like to just go over those two systems relatively quickly, right? So basically, the whole point is that we're mining for blocks of information, right? And in order to mine for these blocks of information, you'll have these two systems set up. Now, POW, proof of work, is basically the system in which Bitcoin will reach its consensus. And what does the consensus do? What it is it goes into a larger network of nodes. And nodes are basically computers that run the blockchain on it. So any computer that runs Bitcoin's blockchain on it is a node, and that means it's part of the larger decentralized entity. Meaning that in order for the network to, let's say, achieve consensus, which is like just an agreement amongst the network, you need 51% of the network to agree with it. And now that's where things get kind of crazy, right? So now you have these nodes. They're validating blocks or information or transactions, whatever you want to call it. And then from there, what happens is that in order for the blockchain to move forward, 51% has to agree with it. Meaning that let's say we were to reach a democratic consensus via proof of work or this kind of system. It actually becomes more democratic because you need 51% to reach the vote or to even attempt to change something on the network. So that's something that's largely missed on in a lot of cases, and that's why I wanted to bring it up. And basically the whole idea is that to reach consensus, you need computers mining. And basically in that mining process, it's just a bunch of computers solving algorithmic mathematical equations to basically say like, okay, we're trying to reach X number, we don't know what the number is, and every computer will be computing to try and solve the number via random things, like random equations. And what happens is every time an equation is solved, a block is mined, and the miner receives Bitcoin, which incentivizes the person running the network to keep on doing it because they're getting paid out, right? Now, another thing that I wanted to mention about that is while you're basically going through the effort of mining, it costs electricity. And this electricity is basically largely what's backing the price of Bitcoin. Meaning that if it costs you $5,000 to $10,000 worth of electricity to actually mine a Bitcoin, that means that is the floor price. It cannot go lower than that because it costs that much electricity to actually do something with it. Now, that's a basic idea of POW. And one of the things that's important about that is as the network grows, it becomes more and more secure because there's more computers mining it. So therefore, the 51% of that network just grows in size. Meaning that, like if there's 1,000 computers mining today and 10,000 mining in a year from now, that means the network has grown 10x, basically 1,000%, meaning that you would need to own 51% of that new number. So now you've exponentially made your network more secure just by making it adhere to that system. And that's something that a lot of people, they discredit Bitcoin. They say, oh, it's old tech, it's dead, it's this. They're dumb. They're genuinely dumb. Or not dumb, maybe that's a crass word, but they're ill-informed, which is why I'm here to inform you. So that electricity cost is what backs a lot of the price of Bitcoin. Those inefficiencies are what allow it to be efficient in terms of trust. And largely what we believe in when we're talking about Bitcoin or crypto is trust. Now, I look at Bitcoin, I know I could trust Bitcoin. Other cryptocurrencies, you can't necessarily trust them unless they prove themselves. They have to earn that trust. So assuming that Bitcoin becomes the stable, consistent, let's say, pillar of trust, everything else is built around that. And what's interesting while we're talking about money backed by electricity was Tom Ford, the guy who invented the cars. He had the first actual concept of money backed by energy in the 30s. He just didn't know how he could explain it. And I understand what he was getting at. His belief that gold and fiat didn't make sense. Gold was too energy intensive and too centralized, and only certain places could get it. Then you have things like fiat, which has nothing backing it, so you can't trust it because you're trusting by someone's word, and people lie. They just do. So Tom Ford had an idea for backing currency by energy for one reason. Everywhere in the world you could have access to energy. And not only that, when you're backing everything by energy, it's like you're taking excess energy that would have been wasted anyway, and you're monetizing it for extra gain. Meaning that like instead of you just going and printing money, which has no costs, meaning that it costs nothing, therefore it's worth nothing, you're taking the best of both worlds. Whereas like gold is an environmental disaster to make it happen, and fiat is just, a lie on a piece of paper. This is somewhere in the middle. This is like, okay, our hydro produces X amount of kilowatts extra per year. We could use that to monetize extra hash rate in the network to get Bitcoin out of it. And that monetization of that electricity allows for, extra money that wouldn't have been there necessarily. Now, it's a pretty interesting concept to think that Tom Ford came up with it in the 30s, but you could actually Google that. That's a real thing, and it's insane to think how far ahead this guy must have been to actually conceptualize something like that when coal was one of the main sources of power and gasoline was just coming into fruition. So he definitely had ideas way beyond just cars. So another thing too that I wanted to mention now, so that's like a proof of work system. That's basically the bare bones of how it works. And a proof of staking system is the same idea of reaching consensus, but without mining for blocks. You're staking for blocks, meaning that as people add their value into the network and people basically spend on the network and use the network, it burns from a total supply and allows you to receive dividends off the network. So by holding it there and becoming part of this banking system in a staking manner, You actually receive dividends off of what's being burnt from the supply just by spending in the economy. And in theory, POS is beautiful for that reason, meaning that like if you have, you could have more. And it's efficient in electricity terms, meaning that it doesn't cost that much to run. So people are like, well, then why don't we just run with that? Well, now I'm about to say something that's very important. So while this system is more efficient, it's actually a bit of a trap. And it's very important that we keep something like Bitcoin at the head of these systems so that we don't end up back in a similar system to fiat for one reason. You look at Ethereum. They want people to run nodes, and the minimum amount of Ethereum you can have is 32. Not everyone has $100,000 to put into running a node. It's out of reach for 90% of people. And if Ethereum hits $10,000, it's going to be out of reach for pretty much everyone. Meaning that the only people that will actually be able to participate in an Ethereum-based staking pool and creating a system of that would only be the elite. That's why a lot of banks are interested in Ethereum. It's because they see that if they buy the Ethereum now and they stake it, over time, as people spend it on the network, they'll actually be the ones holding the Ethereum when the supply dwindles. Then once they control the supply, that becomes a horrible monopoly that we don't want to see, which is why Bitcoin is important, because Bitcoin allows for people to be in it without any form of favoring, meaning that anyone could mine, anyone could be a part of those electrical costs, anyone could be included in that system, and it doesn't have to be like, oh, you don't hold any Bitcoin, you can't be a part of it. So the reason why Bitcoin is important is because it keeps the Ethereum standards and every other digital standards beneath it in check. Without Bitcoin as the head, cryptocurrency, in my opinion, is not necessarily something that we would want to be running like that. You don't want to have all the banks recontrolling the money supply. You don't want that. And the other thing too is Ethereum has an infinite supply, meaning that it's not capped. There's no hard capped, meaning that if the bank takes over the supply, they could then control the supply, which is why it's important to understand when people say like we need to get rid of Bitcoin and only run efficient energy standards. It doesn't make sense. You can't do that. You need Bitcoin there because it keeps all the other cryptocurrencies from becoming out of control. Because realistically there, it's Bitcoin that we trust. And I'm not a maxi. I do believe that other systems will be able to move Bitcoin's value very efficiently. But the thing is that we can't forget that Bitcoin is the bare bones of it all. Meaning that without that skeleton, we're just a plate of jello. So at that point, it becomes its own form of economic system. And I'm going to get into that now. So you look at the gold standard, the greenback. That was the original standard that we adhered to when we first decided to take our gold and back it by dollars. Or rather, take our dollars and back it by gold. Excuse me. That was our first system. It was the most efficient thing because no one could go around just paying for gold. And especially during the Great Depression, when when they first took them off the gold standard, they realized, okay, like we have to have more control over the gold and we have to respect the money supply more. Because the Great Depression was a perfect example of like too many people hoarded. And because too many people hoarded during the Roaring 20s, the economy collapsed. So it is all in relation to each other. Everything has to be respected for the balance. And you had the original gold standard. Then they ditched the gold standard and they went to an oil standard, which was what made the American dollar so valuable. Because they made a deal that if you were to transact in oil, it would be done in the US dollar. And people had to respect that. And in order to respect that, they had to make the US dollar the reserve currency of the world, meaning that everyone had to respect the American dollar. But here's the thing. Backing your money by oil and having the system works for a short time. But after a certain point, we're looking at environmental disasters from oil. We can't do it anymore. We cannot respect an oil standard. It's done. And the thing is now we are watching an old system that has backed its money by oil trying to hold on to that power structure. And that's why you see there's more of a push for green energy. It's not just the environment. Yes, the environment is suffering, But it's also an understanding that like in order for it to get better, we need to kill the old system, so to speak. That's why there's so many laws going in against oil now. Because the barons had so much control, they've snuffed out so much technology to keep control over the dollar and the oil that has become a very corrupt system that we need to basically eradicate or at least shift for the next leg up as a society in terms of having money that's accessible. Now, enter data. Data is the new oil, meaning that every time you click, you are leaving digital oil somewhere. And understanding that realistically, what is money? Money is backed by whatever you think it makes sense at the time. So gold was what made sense 100 years ago because it was, scarce. You couldn't fraud it very easily. There wasn't exactly anything better. Then oil became the next standard. You know why? Gas. The whole economy runs on gas. Everything has to move. Everything has to go somewhere, right? It's gas. It makes sense that the economy runs on it. Data is the new gas. Hence why they call it Ethereum gas fees. Because they understand that data is the new oil. It's inevitable because everything you do, every click you do, and everybody clicks. If you're watching this video, you click to get here. That's leaving residual oil, data, for you to basically give. And that's very important that people need to understand why it's not just backed by nothing. Because most people are like, it's backed by nothing. Actually, no, it's backed by your click and the monetization of your click. The same idea that like everyone has this recipe of like, okay, what are the ads worth? What are this worth? What are all these digital things worth? Now we're actually tying the system together and we're like, okay, this person is middle class. His click is worth between this and this, meaning that to advertise to him, we need to respect what's within his click range. The same idea that someone who's poor will have his respective click range and someone who's rich will have their own respective click range. So it's like you're taking the ads that are just generalized now and you're actually able to target them to an audience that could receive it, meaning that you'll be wasting less money on wasted ad space. And that's a huge problem where it's like they just market and ads go everywhere, but how do you know it's actually going where it's supposed to go? How do you know that the ads are converting properly? Because your ad, let's say you're running an ad for your business, it won't necessarily reach the target audience that you need, because if you just pick an age between, let's say, 18 and 30, you're going to target everyone in that age, but it's not personalized by what they necessarily need. So like if you're a mortgage broker and you're like, I'm trying to sell houses, you're not going to be marketing to someone who can't afford it. But the thing is, in the current ad spaces, you're just marketing to anyone who could see it in that age frame. So you're not personalizing the ads to be more valuable. And that's why data is the new oil. Because we're at a point now where we realize like the clicks are worth more than the oil and the gold combined, because that's what the whole system is running on. And the other thing that's important to really understand about why data is the new oil is because of this. It costs nothing. We are in a phase of a new industrial revolution, and that revolution is based off of one idea: the reduction of costs. We don't need to have massive office buildings and big spaces for everyone to see, because guess what? It's expensive. You need to run electricity for that. You need oil to make sure that things get delivered there. You need all these things that cost. But now, on a digital standard, it is a click. And a click costs nothing other than a database to hold your server. Your costs go from here to here. And then from there, guess what? You don't even need an office anymore because you're employing people remotely. You've reduced your costs fucking 80 to 90% just by running it in a digital manner and using data as your oil. So from there, what you're doing is you're basically taking something that is cost-free and you're turning it into something that is efficient. And not only is it efficient, it's tailored. It's tailored to where it has to be. So there's going to be less waste in response to that. Because now look at it this way. Let's say they realize through all these efficiencies in clicking, they don't need to print, let's say, 1,000 shirts anymore. Because the data states that they're only going to sell 20,000 consistently. So why do we need an overproduction of, let's say, shirts? We don't. The clicks have basically stated 20,000 is how it runs, and it's been consistent like that. If we produce extra, it'll be by customization afterwards. It won't be something that we are just going to produce hundreds of thousands, waste it, and then throw it out, because that's what happens. No one's going to, no company that, let's say, makes shirts is just going to give out 80,000 shirts for free, because guess what? It hurts their brand. Can't do it afterwards. So that's why data will be the new oil of the next century, because that's where we're going. We're building digital economies. We are going into the metaverse and VR. Eventually, you'll be putting on your Oculus, walking through, going, okay, I need a shirt. It's going to scan you based off of your Oculus body type, because you're going to have the suit on in the VR world, and it's going to tell you what your measurements are. Then you're going to say, I want it green with a smiley face and this, and you're just going to do it the same way you would do it on the computer, and then it's going to get mailed to you. Custom. They don't need massive productions anymore. The whole point is to reduce the waste and reduce the cost. And to do it, you've officially cut out the oil, which is killing the environment, pumping it, and not just like pumping it out as well as burning it. You're reducing how much waste you're going to get almost everywhere in general, and then you're personalizing it to what you're going to need in the long run. So that's basically where we're at and where we're going to be continuing to go. And more or less, I'm trying to think, another thing too I wanted to mention was, a lot of people, they look at Bitcoin going up and they see all the prices of these coins going up, and they don't exactly understand the mathematics behind it. So I will take a second now to break down those mathematics. So let's say you have 21 million Bitcoin, right? It's at $0. If, let's say, you put in $21 million into it, Bitcoin is now worth $1. Now at $60,000 Bitcoin, it's because there's $1 trillion divided amongst 21 million shares, and it's fractionalized. And this is where it gets extremely important. An inflationary system versus a deflationary system. So I mentioned before that the ceiling for Bitcoin is as low as the floor for Fiat, because they can only go in respects of each other, right? I'm about to explain why. So this is your 1 Bitcoin divisible by up to 8 decimal points. Now you're thinking, well, what does that mean? What value does this divisiveness of decimals actually have to do? Well, as you can see here, when it's divisible by 8, that's about 100 million. Remove the point. It's 100 million. Meaning that as the currency inflates, every decimal point actually becomes worth more. So as Bitcoin's price goes up, every decimal becomes worth more. And then it becomes a deflationary system hedging against an inflationary system. Meaning that as the money supply expands and basically the supply of Bitcoin dwindles, it fills into each other. Meaning that technically $60,000 Bitcoin is undervalued by up to almost 100%, or up to 100 times roughly. Meaning that if they print trillions and trillions and trillions, let's say they double the money supply every few years, eventually that'll compound. And what will end up happening is that if it flows into Bitcoin, all those inflated dollars, that means that every Satoshi at one point or another might end up worth like $1. Meaning that because it's so it's so divisive, able to divide into so many numbers, even if there's a small supply, it doesn't change how much it could be worth in the future, because that money that's constantly being printed, flowing into Bitcoin, will actually create more value per decimal. So mathematically, it's designed to be the exact opposite of fiat. And that's why I can see it doing so well in the future, because there won't be less money. They are not going to have less money. There will only be more. We just have to respect that that's a possibility. And you could either adhere to the old system, which is telling you, pay your taxes, but we're not going to respect your money. So they're taxing you twice technically. They're taking your, whatever they're taking, your 30 or 40% or 15%, depending on what your tax bracket is. And then they're taking that money and then they're inflating it against you. So it's like, all right, so I paid my taxes. I did what I was supposed to do as a good functioning member of society. And now when I go to buy bread or juice, the price is up. People don't realize, like, okay, so the price of bread went up $1. or the price of juice went up $1, and then the price of bacon went up $2. They're like, it's so small, but go do a full round of groceries. Your entire costs of that, let's say, basket now have gone up 20, 30, 40%. And that adds up. That adds up over time. And then it's going to go down to an even bigger thing now, right? So I mentioned POW, POS, and smart contracts, right? Now Bitcoin with the Lightning Network could send value for as little as 1 decimal point. Meaning that as the network, the Lightning Network specifically becomes better, it is actually more and more efficient than almost any other cryptocurrency. The only reason that isn't public yet is because it's still in beta, it's still testing, but it's testing and it's working really, really well. And with Taproot, that new integration, soon Bitcoin might even have staking, it might even have smart contract applications built into it. Meaning like that's another reason going back as to why Bitcoin, I can still see it as the head of it all. Because the second those updates start, it's inevitable. It's going to be a big thing. And that goes back even to my point with money velocity, or money in general. So inflation, money velocity is another important thing, right? So when banks print money, it's supposed to be redistributed to the economy to get it back in taxes. But the issue is that they're not redistributing it back into the economy properly. Meaning that if the central bank takes in money and just sits on it, there's no velocity. And velocity is what makes the economy run. So if they're not giving any loans, even though they're taking money, it's technically just sitting there. So you pay your taxes and then you don't even get that money circulating into the economy. So realistically, the current system, Fiat, is a Ponzi scheme. And we're looking at the end of it now. It's the end of the Ponzi scheme, guys. And the thing is you're seeing all these countries, they're panicking because they understand that it's coming. There's a reason they hate crypto. It's because they understand that we built this massive pyramid on a house, basically this giant pyramid made out of cards. And what happens to a house of cards? It can only stand for so long. And we're at the point where it's shaking, everyone's holding their breath, and it will fall. And that's why Bitcoin will be the biggest bank. Because instead of looking at it as just a price perspective of this, or of any price perspective, 60,000 or Satoshis or whatever you want to call it, it goes down to one thing. It is a large network holding, let's say, $1 trillion at the time of this video. So it is holding that money there. But instead of you saying, like, I'm going to spend it like I would at a bank, it works more like an IOU. Meaning that you take your Bitcoin, you take your pay in Bitcoin, you're taking all this money in Bitcoin, right? You don't need it right away. It's like a savings. It's in the network. It's there. It's chilling. Then let's say the network grows a little bit. Now you can say, okay, I would like to take my money out, for example. Then from there, it's like you're taking your digital IOU, your Bitcoin, because that's what it is. It's a digital IOU. It's a fractionalized IOU. Then you're like, I need to take it out. Bam, go to a broker, take your money out, pay whatever taxes you gotta pay. Or you could keep the IOU system going, because it's an IOU that could be built on. Meaning that, like, let's say you want to pay someone in Bitcoin now, because it's a service, you're paying for a service, that is technically barter. It doesn't adhere to the same money laws. Whereas if you just pull out cash, that's where you actually will end up hitting your capital gains taxes. But then if you use it as currency, it adheres to currency taxes. So it's a very complicated situation that even the governments don't even fully understand how they plan to regulate it. It's a very messed up thing. And that's why they're panicking, because they don't understand it. And the fact that they don't understand it, they can't build regulations around it, which is why it's important for people who do understand it to be the ones who help to regulate it, because they'll be able to make a system that's not only fair for the people, but will make things happen. Because we can't just not pay taxes. There are things that have to happen. I might not be someone who's for big government, but I understand that crypto and Bitcoin and all these applications could reduce the need for larger governments. We could shrink our governments down and actually make sure that the money is going where it's supposed to go, which will reduce waste by a lot. And that's one more thing that I wanted to bring up about that massive IOU system. We look at the market cap of crypto and the market cap. Well, it is market cap of stocks, because it's also part of that Ponzi scheme, the stock system, right? So crypto is sitting at about $3 trillion in market cap. In perspective now, you have gold. which is about $10 trillion in market cap. Now you have stocks and bonds at $400 trillion. How much room is there for one or the other to grow, realistically, after watching this seminar? $3 trillion with all these applications and use cases and things that, you know, most people can't really say like are useless or backed by nothing. It's a system backed by trust, electricity, and basically, yeah, we don't need more than that. We don't need the words of people to back this system. And that's why I tell people, I'm like, crypto is more of a market to be in, even if it's not financial advice, by the way, because it's not. You should remember that if you're watching this. Always important to say it. But in terms of room for growth, do you think that something like this could flip gold? It's possible. So if it's possible, that leaves room for the market cap to go up a minimum of 3 times. Is that considered a good investment? I don't know. I'm not a financial advisor. But let's say now I were to receive a third of the stock market. That's about, you know, almost 50x from here. It's just getting started, realistically. And that is why I'm bullish. And you're hearing it directly from me, you as the viewers. I'm going to more or less finish off now with some crypto safety and what scams you could avoid. And then we're going to go to our Q&A portion of this. So for the people who've watched this video to this point, and for the people who've been listening patiently and hoping to ask some questions soon, we're going to get to that very shortly. Would you like to cover anything on crypto scams or anything like that? Or?
Yeah, I'll take over. That was a really good explanation on everything. Yeah, lots of information to take in there, and it's obviously a very exciting space because you see how disruptive crypto is as a technology and how it will really drastically change the way that we live our lives on a day-to-day basis. That being said, once you get into crypto, it's kind of like going down a rabbit hole. You want to learn as much as you can, and then you try to get as much information as you can. The thing is, you have to be extremely cautious when you are getting into crypto, because there are so many people out there who make a business out of scamming people who are getting into crypto. And this is so dangerous. There are scammers everywhere. There are scammers in the comments of YouTube videos of big influencers that will tell you to text them and then they'll take your money. There are scammers in Telegram groups and Discord. So the big crypto community is hanging out on Telegram, on Discord, even on Twitter. And there are too many scammers hanging out on those platforms that are ready to steal your money, okay? So I personally just took a really big loss. I got scammed, and you know, like, you always think I'm too smart to get scammed. This is never gonna happen to me. Well, you know, it happened, and for me, the way that they got me is I entered a giveaway, and I got several DMs on Discord, and I'm not tech savvy at all, so I just didn't understand how Discord worked, and I got a DM, and it told me to click a link to connect my wallet, and when I clicked on the link, it popped up this website, but it was a fake website, and it had stimulated my Chrome extension. So it wasn't my real Chrome extension, it was just like a makeshift Chrome extension. And so I entered my password, it didn't work, and then they asked me for my secret recovery phrase. So that is your seed phrase. That is when you open up any wallet, it will come with a secret recovery phrase. Whatever you do, do not ever copy paste your seed phrase, no matter what. Like, if anyone is asking you for your secret recovery phrase, even if it looks like it's the real website, triple check, because they will empty your wallet. Okay, this is so important. And I've talked to a lot of people in the crypto space, and I found out that a lot of people do get scammed. The thing is, people are afraid to talk about when they lose money, okay? So it's very important that we talk about this because it happens way too often, and we want to make you a little more sensitive to this. So don't think that you're smarter than this, because it gets so many people. Watch out for people that are messaging you. Set your settings in Discord and Telegram so that only your friends can message you. And honestly, just take all of the safety precautions. I would even go as far as say, lock up your seed phrase from yourself so that you don't have access to it. Like put it in a safe, put it in the bank, I don't know, lock it up somewhere. Just don't have access to it. Well, I probably wouldn't trust the bank.
Yeah, exactly. I wouldn't do that either, to be honest. Yeah.
I have like a safe at home that like I lock up now. So so just be extremely careful on that, and just don't trust anyone. Don't give your crypto to anyone. If you want to buy crypto, you gotta be smart enough to know how to open your own wallet. Don't trust someone else with your crypto. That's very important. And don't let other people trust you with their crypto. So for me, I had my brother's crypto in my account that got scammed, and now I owe him that money. And so it's very important. Just keep your crypto to yourself and be very cautious about who you're giving your information to. And that being said, I guess it was a pleasure being here with you today and having a chat with you and with Matt and educating you about crypto. I hope you guys got some value out of this and that you understand crypto a little bit more now. I guess we're gonna go to the Q&A.
Yeah, and I just wanted to add in one more extra bit about the crypto safety and scams, and I'm going to do that right now. But I'm going to take off my suit because it's a little bit stuffy. There you go. All right, there you go. So, more or less, what I wanted to finish up there was to add to crypto safety. 100% she's right. Never copy paste your seeds. In fact, be so careful with your seeds. Treat it as if it was your bank account. Would you give someone your bank account? No. And you wouldn't give them any of the things that could access it. Your seed is usually going to be about a 24-word recovery phrase. You could set it yourself on some things, or it'll be given to you regardless. When you get it, write it on paper. And then from there, if you really want to like solidify it, because paper goes bad or it burns, you can get a titanium seed phrase thing, like a sheet, and what you do is you just manually set the titanium pieces for your words, and that is fireproof, it is crush proof, it is everything proof. That is like if you really want your thing to be safe, because then you could lock it up in the floor in the cement and it's fireproof at that point, meaning that is the ultimate way of storing your seed phrase. And if you're really serious about being like secure, you could even set your own words for your ledgers. They have the option. And if you do it like that, that is the most secure thing. You could even encrypt within their little encryption, making up the words yourself. And that really goes to show how secure you could make your own bank account, so to speak. And I wanted to mention other things too. Like she said, don't take messages from people. Don't open links. If you get emails from people that you don't know, don't click any links, because the link, if it doesn't lead you to a false website, it could lead you to a keylogger. And if they have you in a keylogger, that means every time you are clicking away, they're receiving a portion of that information, meaning that over time they could decipher whatever the hell you're doing. And that's something that's scary about keylogging. And that's one of the ways that they could get you, other than getting your seed or just making you click on malicious links or downloading malicious software. And I even wanted to mention something too, because these scams are constantly evolving. They're always changing. And there's one now that's coming out, and I know someone, he got hit for $20,000 on his MetaMask for basically scanning a corrupted QR code. So what the hackers are doing now is they will take their own QR code, they will go to a restaurant, they will sit down at the table, and they'll just put their own thing over it. So be very careful scanning those QR codes in the restaurant. Me personally, I would say ask for a menu, because he didn't just lose his MetaMask. They took his bank account. They took everything from the guy. And I felt so bad for the guy, because he was there, he's like, yo, like, that was like a lot. And I didn't want to tell him, like, you should have put your money in a ledger, because I would feel even worse for the guy, because he just took a $20,000 loss. But the point is that they're getting intricate. They're going to QR codes and putting their own on top of it. And don't scan any QR codes that you do not know. That is one of the most important things that I'm going to tell you, and it's something that I live by. If you don't know where it's going, or you don't know where it's coming from, or you don't know anything about the source of whatever you're scanning or receiving in an email or anything, don't answer it. Don't open it. Even if you want, set up a whole separate account for your crypto and make it so that it only does that, and it's just a separate account. That's one of the safest ways you can handle it. and have most of your shit in the physical world if possible. And that way you'll avoid as much as possible for scams. And I'm trying to think if there's anything else I can leave you on for that, but I think that's more or less it. We're gonna get on to the Q&A part of this seminar now. So feel free to ask as many questions as you want, guys.
Well, you definitely answered.
Hold up, let's take a 2-second pause. We're just gonna change the battery on this.
Do you see my
Do a swap on that too.